Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, March 25th, 2016. Today we'll look at S&P 500 ETF SPY and the difficulties I run into when I'm drawing various chart patterns. The market breadth still remains bearish, but has improved quite a bit actually. Bonds again at all-time highs, and this I think is signaling fear in the stock market. Dollar regained ground against both euro and the yen, and of course this is weighing on various commodities, gold especially. The same thing for oil. We'll look at the difficulties drawing various chart patterns on oil, and we'll look at natural gas and some of the potential bottoming patterns that I'm seeing there. Okay, this is a S&P 500 ETF SPY, like the proxy for the market. So off the lows in February, the S&P 500 ETF really had a pretty powerful run, and uh, we have a close above the 200-day moving average, and basically at this point I'm hearing already quite a bit of chatter about whether or not the market, the S&P 500, the stock market, is indeed in a bull mode. Now, if you listen to my previous messages, I still think we're in a bearish territory. I still am treating this rally as a counter trend rally. I need to see quite a bit of improvement in various breadth indicators that I'm following, and I'm still not seeing those improvements just yet. But today I wanted to show some of the difficulties I run into when I'm trying to draw trend lines. So there's basically more than one way to draw the trend line, and here's one way, and I did it off the tops, like these two tops. But you could also draw off these two tops. So anyways, what I'm trying to say is, maybe this is the pattern, the bearish wedge, the rising wedge, and maybe this is the bearish wedge. It's kind of difficult to say where is the actual bearish wedge. Maybe it was already broken, and maybe it's not yet broken. But the important thing is where the robots see this bearish wedge, and I mean, trading robots, the algorithms that trade on behalf of various traders, where are they drawing this wedge? And if they draw the wedge, the same way as I do, then potentially we already had a bearish wedge breakdown. So next chart, I actually want to show the same chart, but where I removed the the candlesticks, the open, high, low, and close, and I just left the closing prices instead. So here's the chart. It's the same exact chart, except for I only have the closing prices. And you can see what I did is I drew the same thing, the same wedge of the closing prices only. So if I did that of the closing prices, then we already had a bearish wedge break on Wednesday rather of this week. So once again, this just highlights difficulties of drawing various chart patterns, and that's the reason why the chart patterns are really not my primary way the way I trade. Down below here we have, we didn't have improvement in advanced decline line, but the volume is still lacking on this bounce. Okay, this is New York Stock Exchange Composite Index, the very broad market index. Here, actually, I think there are more signs of resistance, and maybe we already had a failure at the 200-day moving average. So you can see the price came up last Friday and kind of touched the 200-day and with a selling tail out of the top of it, and then kind of just fell apart. And then there was also a gap on Thursday. Now, whether or not we will get a rebound, most likely we will get a rebound and the price will reattempt to capture the 200-day moving average. Now, the important thing is that if it does fail here, we could roll over and make a lower low. and then that will be already a negative sign for the bulls. So next week I think is going to be an important week, and if we do come up here and roll over again and make a lower low, then maybe we'll have even more selling pressure as the various trend trading systems kick in, and they'll be looking for short-term trends, which are in that case would be down if we have lower lows. Now down below here we have also New York Stock Exchange Composite market breadth, various indicators. So we did improve in the number of stocks that are pushing higher in advanced decline issues. But as far as the volume is concerned, we're still, the volume has been really pretty poor on this advance, both in on balance volume and the advanced decline volume. We have not, broken out in that department just yet, I think. Down below here we have percentage of stocks above the 20-day exponential moving average, the 50 and the 200-day exponential moving averages. Now, as far as the long term, I still think that we got above, just barely above the 50% here, and then we came right back down. So, for me to even contemplate a bull market, I want to see a surge above at least 60%. Of the stocks above the 200-day exponential moving average, preferably probably 70%. This hasn't happened yet. Now, as far as bullish percent index, we did improve, and it looks like we are actually above the 60%, so that's a positive sign. The shorter term ones, the 50-day EMA and the 200 and the 20-day EMA, they could also be thought of almost like an overbought or oversold indicators, and I think we're overbought, obviously, in this case. So, if we get a plunge down, like for example, we had right here, and then we had a plunge down and a serious collapse to multi-year low. So if we get something along the same lines, I think the once again, the trading systems that are looking for short-term patterns will step in, and most likely we will get a re-challenge of this multi-year lows. Hasn't happened yet. Alternative scenario, of course, like I said, we could bounce up and maybe break above the 200-day moving average. It's always a possibility. Okay. So I mentioned that my long-term indicators, long-term bias indicators that I follow have turned bearish here in September. And I think this is the beginning of a bear market. And as of right now, we still had not had a surge above this blue line, which I would consider a switch back into the bullish market. This is market breadth index, and you can look on my website for that, for the information above it. This here below is one of the inputs for the market breadth index. I call it the raw MBI, and this one looks more for oversold patterns, in addition to being the breadth indicator that I follow. And I would consider it being oversold if we were below 20. We haven't gotten there. We bottomed out at 28.57 here at the beginning of this year, and then we rebounded. So now we're at 52% or so. So what this means is that this rebound, I think, is still a counter trend bear market rally, since I believe we're still in a bear market and we have not had a switch back into the bull market. Now, once again, this can happen quite quickly. Maybe we get a push to all-time highs here, and then market breadth improves, and then this indicator will just flip into the bullish mode. I have no problem buying the dips. At this point of the game, I'm still looking to sell the rallies. Okay, this is AGG, the diversified bond fund, which holds various bonds of the United States market. Last week, I think we had a breakout above this potential pennant consolidation, and then another and actually all-time highs here. This is a all-time high compared to this all-time high. It was only by 1 cent, but nevertheless it was still a all-time high. It was the same thing on Thursday. We hit that all-time high again, but pulled back. What this is showing me is that investors are rotating into bonds. People are buying bonds as a protection against a potential stock market drop further. If some of the commentators I listen to are mentioning that we are back into the bull market and everything is quite rosy and we should expect all-time highs soon and it will just continue. Now, if that was the fact, why would bonds be at all-time highs? This is just showing to me that um, there's plenty of fears and unknowns in the market, and bonds, especially United States ones, are really a safe haven asset, which is clearly getting a bid. On the long-term front, you can see same thing. This is AGG, but this is a weekly chart going back a couple of years. This could be like a cup or maybe a flag consolidation, and the depth of this pattern is around 3%, a little more. So if we already broke out here to all-time highs, and then again we're at all-time highs. So I think we could easily see this 3% duplicated on the upside here. So we could push to maybe 113 or even higher. What this would imply is that we see quite a bit of more fear, and if bonds continue to all-time highs, most likely stocks are going to drop. Bonds and stocks have pretty pronounced inverse correlation to one another. Okay, this is US dollar index, daily time frame, and this is going back to 11 months chart. This week, basically last week we had a plunge below this support. I mentioned this gap, the small gap up here, that it probably will get filled. It got filled this week. You can see it was a small gap here. It got filled Wednesday. So dollar gained against euro and against yen, and I don't have it here, but it gained against the British pound as well. So it gained pretty much across the board in a broad against other currencies. Now, next chart I'll show. Actually, might as well just go there. This is the same dollar index, but in a weekly time frame going back a couple of years. And I showed this chart in the past. So basically we have two levels to watch for the US dollar. One is at 100 and the other one is at 92.52. And if we get a breakout above the 100, then this could be a cup on handle pattern, and this depth of this pattern is 9%. That means that most likely we'll get a move up of around 9%. Alternative scenario, of course, is a breakdown below $92, in which case most likely we will get a retest of this breakout. A breakout above the 100 level would put pretty serious pressure on various commodities yet again. As a matter of fact, this week we had, the dollar rallied pretty strongly all week, and next we will look at gold, and it came under pretty strong selling pressure. Okay, this is a chart of gold, weekly time frame going back all the way to 2011. And similarly to what I have for stocks, I developed an indicator which I call the gold breadth index, because it includes various, not only the gold price itself, but also the breadth measures from the gold miners. So it has pretty decent probability, a predictive value, and so the stock market, the gold has entered the bear market back in 2012, and continued down since then. Now we had several breakouts, potential breakouts that I marked on this chart, even including this breakout, potential breakout. and you can see that this gold breadth index did not confirm a new bull market on any of them. Now, just recently we did get a signal on this indicator, and looks like I'm going to say that this breakout is going to be valid for now. In other words, I will be looking for a long-term, for going long for gold in the near future once the opportunities present themselves. So in other words, I'm now bullish on gold, and unless next several charts I'll show potential levels to watch on the pullback that is unfolding, but those pullbacks could be buying opportunities for the near future. Okay, this is gold daily spot price going back 6 months. Anyway, so looks like we have a breakout here in February above this level from October high, and a continuation higher. And then once again, I said that now the gold breadth index is signaling that we're in a new bull market, and I'm looking for buying opportunities. Now, for me, this is kind of crazy to buy up here because we had a pretty powerful move. This is what is it, 18% or so, maybe 20% of the lows here to the highs. So to me, this is clearly overbought, so I definitely would not be buying up here. However, if we do get a pullback, there could be buying opportunities in the near future. First of all, as I said, the dollar really gained against other currencies here, and you can see that there was this big drop here on Wednesday. As some of the most likely this is positions are being unwound as far as the long positions that people bought down here. Possibly this is already shorting activity as well. I mean, it's really difficult to say, but in any case, it looks like we broke the support here at 1226 as a minor support, and so far as of Thursday we have not been able to recapture this loss. So what it looks like to me is that gold is most likely going to be pulling back to retest this breakout, and this is completely normal. As a matter of fact, it would be quite healthy if the gold pulls back, meanders here and then rallies from here. This is breakout, throwback, continuation. But if we don't hold here, where can we drop next? And of course, there is the 200-day moving average, so this could provide some support. But then further down below here is this broken support, and now broken support, broken resistance here as well. So we had a breakout right there. So this is going to be resistance that turns support. So a pullback target maybe to 1180, possibly to 1140, and ultimately to 1100. Now if we fail here, basically we're headed for multi-year lows, and most likely the new bull market would have failed by then. Now, this is all predicting the future, and it's really difficult to say what's going to happen. Maybe something completely different will happen, and maybe this pullback won't even occur. But in any case, to me, this looks like there's going to be a retest of this breakout, the breakout that occurred here. If that fails, we still have quite a bit of support around the 1140 and possibly even 1100. Okay, this is GTX gold miners ETF. So it's pretty much doing the same thing as gold, only in a more volatile fashion, and that's pretty normal for gold miners. If you're trading gold miners, just be very careful, size your position accordingly. We have the subscribers. I really emphasize the position sizing and not trading too big for your own trading account and avoiding large losses. So there's some videos in the members only site you can take a look at if you sign up. But in any case, when gold dropped here on Wednesday, the miners actually gapped down quite a large gap here and then continued lower. Next day we had what's called an inside day, where this entire daily trading range was inside Wednesday's trading range. So this is inside day. You can also think of it as a triangle consolidation. And if this triangle breaks down, then we can easily see gold miners pull back to the $17 area, and there's a breakout level here at $16, $19, $17. So it's kind of like a normal pullback. There are also gaps, so we can see either a gap fill to the top, or alternatively we could see a gap fill to the bottom. There are gaps here around 1550 or so, and then there are another gap here and actually another gap right there at $13. Now if we fall back all the way down to $13, I think this breakout would have failed by then, because these are all-time lows. Hasn't happened yet, and we'll see if it fails or not. Again, this pretty much depends on the dollar, I think, in my opinion. If dollar really pushes higher, like I said, or if it breaks out above the 100 level, then we could easily see a complete reversal of this breakout and a continuation lower for the gold complex. Okay, this is West Texas Intermediate Light Crude Oil spot price daily chart. Going back 6 months. Here we have multi-year lows on February, mid-February, and then a rally of those lows in the form of a potential rising wedge. Again, as with S&P 500, I really have trouble drawing in the pattern, the way the robots will see it, basically. And if I drew it like this, of the lows here, this line right there, then we already had a bear wedge break. But alternatively, you could draw in the pattern of the Thursday low and the multi-year low here from February, and then in that case we have not had a breakdown in this rising wedge. Interestingly, up here we have the price touched the 200-day moving average, and there was a long shadow at the top. So this shooting star is actually confirmed with this drop. So far the rejection is holding, really. So most likely what will happen next week is we will see price attempt to recapture it. And if it fails, we could see a rollover and a lower low. Now, if we do see a lower low in this short-term time period, once again, as with S&P 500, most likely the algorithms will step in and try to push the prices lower. It hasn't happened yet, but like I said, it's difficult to draw in a pattern that would be suitable for the algorithms. We don't know what exactly algorithms are looking for. All right, let's move on to natural gas. Okay, this is natural gas spot price daily chart going back 6 months also. So quite bearish security again. There's a multi-year lows here at block 6 and some change, and then a rebound in a form of rising wedge. Now again, the last week I had it drawn very tightly around this, this candles here, the all white candles. But then we had this weird looking breakout above the 50-day moving average that failed so far, and then a continuation lower. I don't think we're done with this rebound. I think we may continue higher, and the first obvious resistance is right here at the $2 and 2.172. This resistance right here, it kind of popped through right there. So if we do get up here, then that's a first resistance. There's more resistance here at the 200-day moving average and this peak. And then finally up here at $2.49 to $2.50. Next chart I'll show some of the longer term charts, and I think this is going to be a very important area for natural gas. Also on the left here in blue I have what's called volume by price, which shows how much volume was traded in a particular area of the chart, and you can see that this is a pretty important here on this particular 6 months chart. And that's pretty obvious because there was a lot of trading in this area, so there was a lot of volume in this area. So this could be an important area to test for natural gas, unless of course it just fails right there. Alright, this is natural gas, same chart, but this is a weekly chart going back going back 3 years exactly. So we had a very strong drops in the price, came from almost 650 to $1.61. This is very significant price drops here. Now, previous chart I showed that there was a lot of potential resistance at $2.50, and here you can see even more reasons for that resistance to be there. Here, back here in September of last year, we had a breakdown and a support break right there, and then a continuation lower. This support was from the last year's May lows. That was clearly broken, and we continued lower, rebounded, continued even lower. So we made a discernible lower low so far. Now down below here we have 3 of the indicators. 2 of them are volume based, and 1 of them, RSI, is momentum based. So you can see that we have divergences on all 3 of them. You can see that the price made a lower low, but the indicators did not. They actually did the opposite. They did them higher. They made a higher low. This is a bullish divergence, and again, we could see a potential retest of around $2.50 resistance in this area. If we fail here and we'll continue lower, we can again roll over and see lower lows yet again. But another scenario is breakout here above $2.50, and in that case, most likely the trend would have changed long-term bullish, and I would be looking for buying opportunities by then, surely. Here we have unfilled gaps, so that's going to be an attraction for price around 330, and then around here $4 or so. So it's just something to keep in mind. Yes, we had a very prolonged downtrend in natural gas prices, but we're seeing some potential divergences. However, once again, divergences should be taken with a grain of salt, because, for example, right here we had a potential divergence. Well, actually, yeah, we had a lower low in price, but for example, here RSI made a higher low, and money flow index also made a higher low, yet what happened afterwards was just a feeble bounce and then continuation sideways and a breakdown. So this could be just a kind of like a relief of the indicators here, and we can just kind of bounce sideways and just make a lower low. We just never know. That's it for this week's recap. Thanks for watching. Please stay tuned on how to find us on the internet. Have a nice trading week. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. If you have Twitter, Facebook, YouTube, StockTwits accounts, you can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.